All right, Eel Nerds, episode 190. The Hormuz Strait now runs in front of the New York Stock Exchange, and I am guiding my vessel very carefully to make sure that I can navigate it through this crisis. I will tell you what I'm doing about my portfolio and how I'm navigating the crazy stuff happening around the war. We're up to, I think, 499 subscribers. Sorry, I didn't update it. And thank you for your support. If you're new to the show, I would request that you use the income investing roadmap. Well, a couple of things. First, I want to make sure you don't take my research as the final word. Make sure that you do your own fact checking and trade as you would using your judgment. Well, as I get through the strait in front of the New York Stock Exchange, I'll review the four sections today. The first is the market temperature. I'll compare my portfolio versus the market, which has been unbelievably volatile. And then I have now created a 4-trigger mechanism for portfolio moves. This way, I remove the emotion out of it, and I just go with data, because it's very hard to see how the market is trading. And you sit there and go, oh my God, I either have a fear of missing out in some areas, or I feel like the house is on fire. So I created a mechanism where I can objectively trade, and I'll review what they are. And so let's get going. My portfolio in terms of equity has kind of sort of stabilized at the 12 and a quarter-ish mark. And there are a few things that I look around and I see. This is today, March 20th. The market is ablaze, 2.5% down. It is just scary as scary can be. The entire last month has been an exercise in, absolute nerve-wracking trades. The Dow down almost 8%, NASDAQ 4.5%, the Russell down 8.6%. Ouch! So you look at something like that. We are halfway down what somebody would call an absolute stock market event at a 20% drop from the peak, whatever peak it is. So that may be coming very, very soon at the rate at which this is going. My 3-month performance, in the meanwhile, has been steady. I'm actually up 1.4% over the last 3 months, while the NASDAQ has been down 5%. My 1-month performance is showing a little bit of a ripple. 1 month I'm down 0.5%, and the Russell is down 6.5%, and the NASDAQ is down almost 3%. Now, why is it that I'm barely registering a ripple while the market is absolutely getting demolished? I'll tell you more about it. My fixed income portfolio is really the reason, because 86% or 88%, whatever it is, of my allocation is to fixed income. And as you can see, my fixed income portfolio still has dips because the long end of the curve, there is some bear steepening. But at the end of the day, there is an income that is being produced and it balances it in total. And so my 3-month on the fixed income side, I'm up 1%. And the big tremors that are happening, even in the last 1 month, if you look at the fixed income side, the munis and the agencies, which really don't move a lot, the last month for me, I'm only down 0.12%. And that's why I'm able to look for and not get emotional and trade with a lot of conviction. So how am I thinking through this? Before I go farther, I want to let you know that I'm not a wealth management advisor. I'm sharing how I am thinking, and you do you. My asset allocation is very different. 86 something percent to fixed income and T-bills, 14% to growth, and I'm beating the NASDAQ by almost 13 percentage points over the last 6 months. My fixed income itself, within that, is also a very inelastic sleeve. That is what protects me. And the reason it is inelastic at the end of the day is because it also is illiquid. Let's be real. There isn't a lot of trading that goes on. Most of the people that own FFCB and FHLB, they are in pension funds and banks. I, on the other hand, own that as an individual. And so almost half of my portfolio is in agency bonds and munis. and I have 170 plus that I just intend to keep around. If they get called, no problem. If they don't get called, they'll just be there as an anchor to my ride. And these give me a nice, healthy coupon of around 5.5%. And I have my firepower, 31% of my portfolio in T-bills, and these are going to mature in the next 4 weeks, 5 weeks, something like that. And on my equities, I have 53 positions across 15 sectors, so practically every sector you can think about. I have an allocation. I do not put more than about 0.2% on any equity. Business development companies I use to juice up my revenue, and I only have four, and I talked about which four they are and why they are those four in the previous episode. I do have two ETFs, and they are mainly there for income again. JAAA, which is a collateralized loan obligation, AAA debt, and SCHD, which is dividends. So why do I trade in this way? Ultimately, there are four core principles. First is I have a thesis on four scenarios. I'll tell you what those scenarios are. And within those four scenarios, I have various triggers. Now, I use the triggers, and I'm going to review them shortly. I use the triggers to figure out how I should change my asset allocation. Should I put more in equity? Should I put less in equities? Those are all based on triggers. I do focus on getting income, and my income is derived from taking slightly more risk. And what do I mean by that? Business development companies, preferred stocks, pipelines. There I go for the income. But at the end of the day, my firepower is in the T-bills that I deploy right away. I do want to acknowledge the folks behind Claude.ai. I was able to write my notes and ask Claude to come up with visuals, and so it saved me a lot of time. Thank you, Claude. Well, what else is happening? I have exactly one gold stock that is Newmont Gold, and that has been up in flames. Gold is down 10% this week alone, and there's a lot of outflow. And you have to sit there and say, wait, I thought gold is the rush to safety. It's the safe asset. Well, it's only a safe asset in an environment where interest rates are low. If people think the real rates are going to be high, because inflation is going to be high, gold is not an income producing asset, and so gold gets dumped. The second thing that also happens is the strength of the dollar. As dollar strengthens, gold weakens. And last but not the least, to cover all of these losses that are happening in equities, traders are having to dump gold and cover margins. And so gold is getting hit in many different directions. And so I'm really not going to add too much to gold. I'm just going to sit here and watch what happens. And there are all these predictions about, is gold going to go up? Is it going to go down? I have a really small allocation with just one. My total allocation to gold is 0.16%. And at this point, I'm not going to add more. I'm just going to chill and see what happens. Well, so if that is not my strategy, as you can tell, I am in a little bit of trouble. The boat captain who's hauling that tanker across the New York Stock Exchange Strait with dollar bills. I'm also in the water, but I'll tell you what I'm doing, and I'm doing the best I can. So what is my portfolio and what is the strategy? I had to come up with the four possible ways the next 3 to 6 months would go. One is Chairman Wash comes in, and I know there are some questions about whether he's going to be confirmed or not, and I think one way or the other it'll happen. So Chairman Wash comes in and rallies the troops, and he says, let's drop interest rates, go, go, go. And oil is no longer, expensive. Oil is less than 80. And in that scenario, I have a few stocks that will vastly benefit from it. And however, the odds of that scenario, as you can imagine, are pretty low given what's going on in the world. The second is, Chairman Wash is able to decrease the short end, but the long end goes up. That's called a bear steepener. This is happening today. If you look at the 10-year today, it is 4.39%. That's crazy. It is the highest it has been since July of 2025. And if that continues, and it certainly is a higher probability, then there are certain things that are going to win, but others that are going to lose. And that is the scenario where business development companies will excel. Why is that? If the short end decreases, the companies that have BDC debt will become more financially secure and they will pay back the BDCs. The defaults will decrease and their income will be higher. So I'm holding on to BDCs in that scenario. There is a third one, which nobody likes, but unfortunately, it probably is the most likely outcome, which is stagflation. Chairman Powell, the outgoing chairman, said, whatever is happening now is not stagflation. Stagflation is the thing that happened in the 70s. And you research what happened in the 70s, inflation was high. Sure, it was not 3%, it was higher than 3%. Unemployment was high. Sure, right now it's not that high, but it is increasing. Oil was high, that also happened. So there are a lot of parallels. It kind of is quacking like a duck and walking like a duck and flying like a duck. And so whether it's called stagflation or not, this messy thing is what appears to be happening. And in that scenario, you kind of need some stocks that have a steady eddy kind of income. And that is where I picked some of these stocks that are ExxonMobil and a couple of pipelines, Kroger, the grocery store, Waste Management to pick up trash, Raytheon. These are companies that, in my humble opinion, and you should do your own research, that will benefit no matter what happens, and even if the economy is stagflated. And then the last but not the least, which is the crazy scenario, which is a recession. And if we end up there, we end up there. In that scenario, gold will pick up and T-bills will be king. And so I kind of take every one of my stocks and I do use Claude to weight the stocks for their suitability across each of these, and then take a weighted average of the score and then trade based on that. So when do I trade? Now, when do I trade? I've also come up with a framework for that. This way, I don't need to use emotions and I'll just use logic. So there are 4 events I wait for, and I have dry powder, which is treasuries. The first thing I see is, hey, did oil drop back to below 80? Well, obviously, it doesn't look like that is going to happen anytime soon. Second, are ships able to transit through the Hormuz with their transponders on? At the moment, they cannot. Did whoever is in power in Iran, did they make some kind of a concessional speech saying, okay, well, we're going to let them go by, we're going to let these ships go by? I mean, there's a lot of talk, but nobody dares to go through. And the last but not the least, 4.39 is insanely high. I'd like to see it around 4%. Those are my 4 triggers, and I've listed specific ways to monitor. Brent crude price is very easy. You can Google it or you can look at TradingView. As far as AIS transits, there is a website called Marine Traffic. If you go there, you can see the number of ships that transit the Hormuz. And the news will tell you whether there is some kind of a de-escalation attempt. And the T-bill is very easy to monitor, or the Treasury, 10-year Treasury. And so these are what I would call getting out of stagflation. If more of these fire, I would feel like we are out of stagflation. So what I then do is sit there and say, in the next 2 weeks, what is likely to fire? The odds of oil going below $80 in the next 2 weeks is next to zero. The odds of ships transmitting with their indicators on, there is some talk of compromise. Could the government give some kind of conciliatory response? It's possible. The T-bill going from 4.4% to 4% in the next 2 weeks, I just don't see it happening. The reason the next 2 weeks is important to me is I have a big T-bill maturing, and what I'm going to do is in about 4 weeks, I will be able to take a quarter of my portfolio in dry powder and ask the question, did any of the triggers fire? If none of the triggers fire, I'm just going to roll that T-bill, keep that dry powder. If 1 fired, 2 fired versus all 4 fired, then I will get into equities. Otherwise, I am going to sit out of equities, except I'm going to keep increasing CLOs, I'm going to keep increasing things that will win no matter what. So then the question is, what about a recession? How can I monitor a recession? Because very few things do well in a recession. I again created a 4-pillar view. The first is, this is not that hard. You can monitor every Thursday employment numbers. The one that I've been very interested in lately, and if you don't know what Fred.St. Louis is, please Google it. You can actually see the spread between high yield bonds and treasuries daily. And as the spread increases, which means people are saying, "Ooh, I'm getting nervous. I need a greater and greater premium to hold high yield bonds," that tells you that a recession or noises of recession are becoming nearer because people are nervous about it. The next part that I can easily monitor now is manufacturing. Recession is by definition a decrease in GDP 2 quarters in a row. So I monitor that. And the last part is consumer spending, which is a major component of the economic output of society. So this will help me understand whether there is a recession. The previous one will help me understand whether there is a de-escalation. You put those two together, I can then stand on the sides. I don't have to be on the straights. I can stand on the sides and pilot that wonderful ship full of money. And here is how I'm doing it. The first thing I'm doing is keeping plenty of dry powder. 25% will come into cash in 4 weeks, and the other 10%-ish will be in another 6 or 10 weeks. And the other half, about 55%, is illiquid, and those are the ones that are in muni bonds and in agencies. I do have collateralized debt obligations that I'm increasing every day, and my positions are all public. I'll post the link in this episode. You can go there and see exactly what I hold and how much of it I hold. And I would love to learn from you as much as I hope I taught you a thing or two. Please remember, even a broken clock is right twice a day. Trade carefully, and thank you for watching Yield.